Good morning, everyone. I'm Ben Driggs, Navigate Financial. On the call with us, we have DJ Bassett, my colleague, and we welcome you to this month's webinar. We're going to be talking about retirement planning, and we will take it here to the bottom of the hour, 30 minutes. We really appreciate you taking a few minutes out of your day to talk about these important issues related to finances. And for those of you who are new to the broadcast, by way of information, we have this webinar every month. It's the second Thursday of the month, 10 o'clock Mountain Time. And what we're doing is each month we're talking about one of the topics we have on our overall, what we call a roadmap. So a person can, obviously we do investments, and coincidentally next month we'll be talking about investments as one of the monthly topics. But we cover insurance. So far this year we've done accounts management, we've done cash management, we've touched on taxes, we've done retirement and aging a couple of months ago. Not to be confused with retirement planning, which is, before retirement, which we're going to be talking about today. So that's what we do every month. And we love what we do. We have a lot of people on the call. And again, we appreciate you taking the time. Before we get started here, I just wanted to let everyone know, if you didn't get an email from us directly as our direct client, we did put out onto YouTube a market update last week, and we have that in written form and also in video form. So if you wanted to, hey, what's going on with the market? What are their thoughts? We put together something for you to look at. So let's go ahead and start. Oh, DJ, go ahead.
Yeah, a couple things before we hop in, kind of housekeeping things. So touching on that market update, for anybody that wants to see that, either you can look up Navigate Financial on YouTube, or if you want to go to our website, there's a media tab, and we do upload links to all of our videos, obviously recorded webinars. So past webinars, you can go view those, look at the topics and see what those are. But we'll also start posting these market updates for each quarter. We'll do that once every 3 months. We'll post those on there, just short little 10-minute video that you can sit, watch, listen to, whatever, to get, feel like you're in the loop on what's going on to some degree. So, okay. And then the other thing is, we do have a Q&A feature on the webinar here. So as this is going through, if you have questions pop up, put them in there. There's a spot at the end of this presentation, as usual, that we'll go through and answer some questions that you guys might have. So as things come up throughout the presentation, throw those in there, and we'll review them as we go. And so yeah, don't be shy. We love questions. We want to make sure that you walk away with, you don't walk away wondering about certain topics. So anyway, so that being said, I'll pass it over to Ben.
Okay, so can everyone see the agenda for today? DJ, is that?
Yeah, we can see it. We're good.
Great. So this webinar is for everybody, even though it says retirement planning. People think, oh, that's when I get older. But retirement planning begins as early as possible. We create habits. We create investment plans. We're thinking about debt reduction. So retirement planning is not something we start thinking about when in our 50s or 60 or just a couple of years before we retire. Ideally, we want to be thinking about it throughout our lifetime. And the goals today, we want to help you be thinking about what are the questions that we're talking about with clients when they are wanting to talk about retirement planning, and what are some talking points, what are some things or some specific tools that we use to help people through that process, and what are some steps. And in the very end, we want you to be able to create a retirement plan, and we can help you with that at no cost, and just start the process. Hopefully by the end, you'll send us an email, give us a call and say, hey, I want to do a retirement plan. That would be considered a W for us to be able to have that for everyone on this call. So before we jump in, let me just touch quickly one slide on the big, beautiful bill provisions that may impact savers and retirees. I'm not going to read all of these. You can read them. But the bottom line is the bill that passed a few days ago, in general, is tax friendly, right? And that is what, for fiscally conservative people, it's disconcerting because they say, hey, that everyone wants a tax cut, but it's going to cost money. You got to pay the bills some way. And so fiscally conservative people are a little upset. But, you know, practically for everyone on this call, it's going to be helpful. We will have less taxes. We may not feel them. It's not that significant for most people on a day-to-day basis. But here's a list of some of the things specifically related to retirement income, like maybe paying a little less on the Social Security tax, and saving some broadening of 401k and solo 401k provisions, how much we can put into our retirement accounts and the like. So that's just a little thing that I thought we'd throw in there based on the fact that just passed a few days ago. So anyway, we want to plan. Why planning matters. People are living longer. There's, you know, a generation ago, certainly 2 generations ago, a lot of things were more reliable. A lot of people had access to pensions paid by their company, Social Security, which was stronger back then. But today, pensions are pretty much a thing of the past. People have to rely on their own savings more than ever. And the future of Social Security is also, I wouldn't say it's in jeopardy, but it's clearly compromised. And so people are already projecting out a reduction in the anticipated Social Security income benefit that they are going to receive. So with these things, we really need to, figure out ways to solve these problems ourselves. Healthcare costs are very expensive, and we want to plan early. Obviously, yeah, the compounding effect, taking advantage of that is important. So just a couple of things here. What's happening in the United States, only about a third of people feel on track for retirement. And slide number 3, half the people don't have any money saved for retirement at all. Those who have money saved, average savings is just under $200,000. And the projected amount someone would need to keep up with his or her spending is over $1 million. We don't want to scare people off at that number. Sometimes people read, oh, I have to have 2 million, 3 million. That's huge number. We see a lot of people retiring comfortably with less than $1 million. And most of that is a function of debt. So we want to be very sensitive to focusing on minimizing debt, particularly when we're young, getting those habits of frugality at a young age. But particularly as we get older in our 40s, 50s, 60s, we want to be aggressive in debt reduction so that when we do hit retirement, the amount of money we need each month is modest. So here's the average monthly benefit, just under $2,000 for people, according to the Social Security Administration, and that replaces about a third of their income. So we've got to get 2/3 of the income replaced by some other sources. So we need, in this middle column, we have personal savings. We're going to be a lot of people are working part-time during retirement. We might have some real estate income. That's a really good thing. We have a rental property, and some people are factoring in, maybe they could have a one-time event. They sell their house, clip off a couple $100,000 on that transaction, and that can help them. Inheritance is not listed here, but inheritance sometimes comes into play with people who are getting into the late 60s. Parents are now passing, and sometimes there's some inheritance, which is another income source. And we want to talk about diversification. Key elements of a retirement plan. I think number one and number two are really the core elements. How much income do we need? That is often a starting point. And a rule of thumb is we want to get about 70 or 80% of our current income tends to be a comfortable number during retirement. So let's say the household income is $100,000. Then we want to say, okay, then how can we get $75,000 a year for retirement? And is that going to be enough? Well, if you're living on 100 now and you're not going into debt and you might be saving for your retirement, you're probably going to be okay at 75,000. But anyway, that's an important number we'll look at. Number two is how much do we need to save? A common goal is 10 times how much you think your income is going to be at age 67. So again, we say at age 67, income is going to be $100,000. Then I need to have about $1 million saved up. Very, very rough numbers. We want to use the retirement plan because, and we do this almost every day with clients, is that we go through the retirement planning process and we determine, okay, with all these assumptions, life expectancy, investment rates of return, inflation, different taxes and things like that. These computers all figure these things out. We say, okay, there's a 90% chance that you are going to be okay during retirement. You're not going to run out of money. And we say, okay, that's satisfactory. Well, that is assuming a certain rate of return. So let's assume that rate of return is 5%. So we say, hey, if you can get 5% on your investments, you have a 90% probability of a good outcome. Then we would want to position the portfolio to get 5%. And we don't want to be we don't want to position the portfolio to be all stock that might be targeted for 8% when we really only need to get 5%. But sometimes we might want to shoot for 8% for completely different reasons. So that's part of the discussion, really. What are our objectives? Do we want to have a lot of money during retirement? Do we want to pass on extra money to our beneficiaries when we die? Or are we just barely trying to squeak out a survival rate? And if we're just barely on the edge of survival financially, then is the most prudent strategy to be conservative and avoid the down draws, but then your money's not going to grow as much, right? So you have to, this is the art. It's definitely an art more than a science. And then lastly, we factor in, healthcare costs among other expenses and inheritance and stuff we'll talk about. So, let me just take a break here. DJ, do we have any questions, by the way?
No, not yet. So yeah.
Okay.
Yeah.
Okay. Please let me know if you have any questions for sure. Type something up. So for people who are getting ready for retirement, we want here a few different strategies. Number one is we really want to be aggressive on the savings side, number one. And here's some numbers here about how much you can save into retirement accounts. If you're saving in excess, which would be a pretty big number, but if you're really in strong savings mode, give us a call. We can talk about how you can save that extra money in addition to your 401k and IRA accounts. If you do have extra money, then you're probably in a pretty good position. But it does raise the question, do we want that money to be really conservative and invested perhaps in a conservative brokerage account? Or do we want to keep that money at the bank? Or do we want to buy a piece of property? Things like that come into play. We want to delay Social Security as much as possible. For almost everybody we talk with, mathematically, it makes better sense to postpone until age 70. Even though you can start taking money at 62 with a penalty, and even though your full retirement age might be 67, and people are thinking, oh, I'm going to retire at 67, take Social Security. In most cases, if you can carve out a strategy from the time you retire, whether it's 62, 65, 68, 70, whatever it is, until age 70, if you can bridge that gap, then the rule of thumb is push it back to age 70. As a very rough number, if your life expectancy is approximately age 80 or longer, then you're going to want to push that. If, on the other hand, you don't have good health, or you have a family history of dying earlier than 80, and everyone's in your family's died at 72 or something, then you might want to start taking it at your full retirement age at 67, because once you die, that benefit goes away. As I mentioned earlier, we want to be sensitive to debt and avoiding that in the first place, and structuring it. If we have debt, we want to make sure that we're structuring that debt wisely, strategically. You can call us. We can talk about how to make sure we're doing that the right way. And then we want to pay that down as aggressively as possible. And typically, as we get closer to retirement, we will move to a more moderate or conservative portfolio for reasons we can talk about another time. But that intuitively, oh yeah, you get older, you become more conservative. There's something to be said for that, both in terms of how people start thinking more conservatively, and also mathematically, it often pencils out better to be a little more conservative during your retirement years. For younger people, begin as early as possible. We know that compounding phenomenon, it's very exciting to watch. Takes a long time to build, those first few thousand, then 5,000, 10,000, 20, the first 100,000. It just takes forever. And then things really start kicking in due to compounding. So take advantage of that time. For sure, take advantage of any employer matching. Avoid debt as much as possible. We want, your money working for you. When you're in debt, you're giving interest to somebody else. They're making money off you, and you want to be the beneficiary of your own interest. And then we want to create things that are automatic as much as possible, either into your 401k account, or if you have, hey, we're going to put $100 a month into a savings account, try to do that automatically through some sort of a systematic contribution, rather than, when you just happen to have some extra money. I think that we're almost there. Do we have any other questions? Do you have any questions?
No, nothing's come up yet. So,
okay. We have about 10 more minutes, and let me go back to the presentation. So in the final 10 minutes, let's talk about what it means to complete a retirement analysis, to kind of go through that process. So when we help people through in retirement, planning exercise, there are a few things that we ask lots of questions. We put it all into the mix, massage it back and forth, talk with the client. Often there are multiple discussions to make sure that we're comfortable with the numbers. In the end, you're going to get a plan, a roadmap. That's really important. A sense of where you stand, what you need to do to accomplish your objectives. We have a sense of how much income we're going to be having. As I think earlier I wrote down, I didn't touch on it. There are different stages in retirement. Typically, we give more money, or we allot more money for the people in their 60s. And then that slows down in the 70s, slows down in their 80s. So let's say in the earlier example, we want to target income of $70,000 a year. We're probably going to want to have 70, maybe $80,000 or $90,000 in that first decade, bump it down to 70 in the second decade, and then down to $50,000 a year in your 80s. Because most people in their 80s, they just don't spend very much money, except on perhaps healthcare, and we have to factor that in. Anyway, I talked earlier about matching our investments to the plan. So once we determine, hey, this is an optimum rate of return that we're going to target, 5%, 4, 6, whatever it is, something in that range, then we on the investment side can start saying, oh, what is the most efficient risk sensitive way to get 6%? Because you can get 6% by being relatively aggressive, or you can get it by being a little more cautious. And so we would say, hey, well, if we're trying to get 6%, let's try to get there with a smoother, less stressful investment strategy. We also talked about Roth conversions. Do we convert pre-tax retirement accounts into after-tax Roth money? Most of the time, we've talked about this in prior discussions, it usually pencils out to convert those assets, take the short-term hit, even though it's a taxable event. It seems counterintuitive. Why would you give the government money any sooner than you need to? But it does usually pencil out in the long run. And we will have that as part of the discussion, the merits of doing a Roth conversion or not. Different events, we talked, inheritance, downsizing, early retirement, purchasing a second home or another big expense. Maybe you need to plan for living longer than usual or shorter than usual. We have to factor in assisted living. Maybe you have a special needs child that you need to be taken care of, or some other extraordinary kind of an expense that you anticipate, or that maybe could be a probability. We need to factor all those things into the analysis. And then lastly, if you're tracking ahead, and a lot of people are, interestingly, particularly people we talk with, because we often talk with people who actually do have investments, not the 54% of people who have nothing saved up. Although we would love to talk to them for sure. If you have nothing saved up, we want to talk to you. But most of our conversations are dealing with people who already have money. And a percentage of those population, of those people, are ahead of their expectations. And so we'll run a retirement analysis and we say, hey, at this rate, statistically, if things go along as planned, when you die at age 90, you'll have $1 million still in your account. And that begs the question, well, if we're going to die with $1 million, why don't we start giving away the money sooner? Things like that. And if so, to whom and why and when? Okay, we just threw in a few slides. These are just some samples. DJ, you want to talk about these?
Yeah, I'm happy to talk through these. We did have a quick question that popped in while you were talking there. So if we can, do we want to hold that off?
Go ahead and ask the question, and then we finish off with these slides.
Yeah, so the question is, how do our retirement accounts hedge against market dips? For example, if I plan to be retired at 65 to 67, but the market unexpectedly goes through a bear market the year I turn 65 and continues for a year or more. So kind of that right when you're retiring, if the market goes down, how do the accounts hedge against that? What can they do?
Okay. It's a really good question. And I'm gonna touch on it to teach a concept that probably people don't know or haven't really thought about. It's a mathematical phenomenon that is relevant to this discussion. And that is this: when we're growing money during what we call the accumulation phase in your 20s, 30s, 40s, 50s, 60s, it's going up, 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 up. And sometimes your market goes up, down, up, down, up, down. The order of when the market goes up and down doesn't really matter. If you get 5% a year, when those five, up and down, whatever. However, that is not the case once you retire. When you retire, you stop saving money, you start withdrawing money, and it's a whole different rule. So the math says this: the first few years of retirement have a disproportionate impact on the long-term outcome compared to the later years. So you retire at 65, you have $1 million, you're so happy. It's like, I've worked really hard, I have this nest egg. You stop saving, the market is going down, and you're withdrawing money. Worst case scenario, that will have a disproportionately negative impact on the long term. Conversely, if you get lucky in the first few years out of the gate during retirement, the market has a bull market, then you get disproportionately rewarded. Being a risk averse by nature, my thinking and recommendation is, in your early retirement years, you want to make sure that to take at least a portion of the portfolio and make it conservative, because you do not want all of your money to go down just at the very moment you start withdrawing money out. So that's a great question, and we're sensitive to that conversation. So DJ, in the next final couple of minutes, you want to go with these last 3 or 4 slides?
Yeah. So I think, and hopefully Ben answered it there. That's part of the reason for these retirement analysis, right? And these are the conversations that we have, especially with people that are nearing retirement, is, you may not need to be as aggressive as you are for exactly what Ben is mentioning here. Have a little bit of cushion in the form of cash or bonds or something that's a little bit more conservative, so that you can feel comfortable, especially in the first few years of retirement there. So when we would sit down with people, this is just, we have a few slides that are snapshots of pages that are a part of the retirement analysis after we run it and when we share it with people. So this is just an example of somebody, a sample client that is 54 years old, and they've saved up a bit and just looking towards retirement and planning for it there. So with these pages, these are some of the things that you would walk away with this snapshot here. We would want to go over probability of success of whatever plan that you have in mind. Obviously, the younger that you are, it's more open, but as you get closer to retirement, that might be a tighter window for that probability of success. You'd be able to see, the asset simulation there over the years, what the portfolio does, and when you're going up, Ben's mentioning this accumulation phase. You can see up until retirement it going up, and you can kind of have a visualization of that, the balances and what that looks like. And in a lot of cases, the goal is it'll kind of taper out, and that determines that higher probability of success and what that number is. Going over, you'd have a balance sheet, the net worth, that sort of thing. We go through the investments, showing what you're currently invested in, and then also kind of the target allocation too, of what we'd say, hey, you might want to move in this direction. And then also, you see here the tax allocation. We want to keep in mind and be sensitive to what the tax treatment is on different assets that you have. The 3 buckets there, you see taxable asset, tax deferred, and then tax free. You have the bank accounts, the brokerage accounts. Tax deferred would be your traditional IRA, traditional 401k, and then that tax rate would be that Roth there. So being sensitive to those and being aware of what money is at which bucket. How do we pull money out of that? When you get to that point, what's the order of operations? How should those different buckets be invested? These are all part of the conversation of the retirement analysis. If you want to go to the next page, and we'll just kind of blitz through these here. Like I said, going through this is an example of somebody that's nearing retirement and saying, hey, at retirement, the goal is to be preservation. We want to be more conservative, and here's what we need to do to get, to balance it and get back there. These are the returns that we're assuming, that sort of thing there. You can keep going here. Like I said, looking at the probability of success. Now, in this case, they have a current plan that it's not bad, it's good, it's great. But what we would propose is stuff like waiting till 70. In this case, it was waiting till 70 to take Social Security. retiring a little bit differently, just slight tweaks to the asset allocation, slight tweaks to, to what they're currently planning on. We're saying, hey, you can have a better, better probability of success, but that does come at the cost of, your ending portfolio value, but you still end with enough. So balancing that. So we say, hey, let's go for higher success. That's a, example of something that we can see here. And then I think the last thing that we have on here, this is another page that we like to share with people, is going year by year and breaking down what that looks like for you. Money coming in, money going out, taxes, just giving you a high level of, and then even on the far right, your net flow of out of your portfolio. Are you adding to it? Are you taking out of it? Or are you living off of other income sources and not really withdrawing on the overall balance? So you can see here that year to year, all the way up to, we do assume life expectancy of 90, but it could be any number we put in there, higher or lower, just going year by year. And so you can say, I have a rough idea of what it's going to look like in 2037 or in 2048 or 2060. I kind of have a rough idea of, this is the plan. If I'm doing, we know the habits that you have at an early age or before retirement, and you can say, if I keep doing this, odds are at age 82, this is what my income will look like. This is what my expenses will look like, the tax payment, and what that impact has on a portfolio. So really a lot of benefits here to doing this retirement analysis. I know we're a couple minutes over. So one thing that I will say, and I'll send it out to all, I'm sending it right now on the chat, is reach out to us. Ben, myself, call our office, all of the above. Reach out to us and get started. No matter what your age is, even if you're young, it might be a quick conversation to put something in place so you can feel comfortable. Or you might be nearing retirement and you want to make sure you're on track, or wanting to even just see where you're at with what you've done so far. I put out there in the chat our office phone number, our emails. Send us an email, give us a call. We are more than happy to talk with any and everybody that reaches out to us, and putting together and giving you something that you can hold in your hands, a retirement plan that you can feel comfortable with. And obviously, if you're younger, maybe you're not, maybe you don't have all the habits that you would need to, and so helping you get in line for a retirement that you want. Obviously, that's the younger you are, the better, but helping you get onto the path to where you'd want to be in retirement. So anyways, last little plug there. No cost, no nothing. Reach out to us. We love doing it. We love talking with people.
Fantastic. Thanks, DJ. Thanks, everyone. We really appreciate next month, the second Thursday in August, we'll be talking about investments. Until then, have a wonderful summer. Take care, everyone.